This is larger than 1980. The supply cliff exposed. Right now, beneath every economic headline, beneath every market rally, beneath every reassuring forecast from central banks, something is breaking. Not slowly, not gradually, but with the precision of a structural collapse that has been decades in the making. In 1980, the world faced an energy crisis, a supply shock, a recession. But what is unfolding today is not a repetition. It is an amplification. Across semiconductors, rare earth minerals, pharmaceutical ingredients, industrial machinery, agricultural inputs, the foundations of modern production are crumbling. And most businesses, most investors, most policymakers have no idea it has already begun. The cliff is not ahead of us. We are already falling. Welcome to Financial Inspection. If you have been navigating business and markets long enough to remember when decisions were made with patience, precision, and a respect for the fundamentals, then you understand the value of information that cuts through the noise. This channel exists for that purpose. We would be honored if you would subscribe, not because we ask lightly, but because what we examine here requires your time, your attention, and your willingness to see what others refuse to acknowledge. And before we proceed, tell us, from which corner of the world are you watching this? Which market are you operating in? Because what we are about to reveal applies everywhere. In the spring of 2024, a procurement manager at a mid-sized manufacturing firm in Ohio noticed something unusual. Lead times for industrial components that typically arrived within 4 weeks were now stretching to 12 weeks, then 16, then 24. He mentioned it in a quarterly meeting. His CFO dismissed it as a temporary disruption. By autumn, 3 of his primary suppliers had stopped accepting new orders entirely. This was not an isolated incident. Across the industrial landscape of North America, Europe, and Asia, similar patterns were emerging in boardrooms, factory floors, and supply chain operations centers. Quietly, without headlines, without market panic, the foundation of modern production was shifting beneath everyone's feet. The phenomenon has a name now, the supply cliff, and it is larger than anything the business world has confronted since the early 1980s. But here's what makes it different. In 1980, the world faced an energy crisis. Oil prices surged, inflation spiraled. Central banks raised interest rates to crushing levels. It was painful, but it was visible. Everyone could see it. Everyone could measure it. Everyone could respond to it. The supply cliff operates differently. It does not announce itself with price shocks or dramatic shortages that dominate news cycles. Instead, it reveals itself through 1,000 small fractures spreading across the global production system. A semiconductor manufacturer in Taiwan extends delivery schedules by 6 months. A rare earth processing facility in China reduces output capacity by 30%. A pharmaceutical ingredient supplier in India exits the market entirely. A machine tool producer in Germany increases prices by 40%, while simultaneously lengthening wait times. Each incident, viewed in isolation, appears manageable. A minor disruption, a temporary setback, nothing that demands strategic reassessment. But when analyzed collectively, these fractures form a pattern, and the pattern reveals something deeply concerning. The global supply infrastructure is not experiencing a cyclical downturn that will reverse when economic conditions improve. It is undergoing structural deterioration. The difference is critical. Cyclical problems are temporary. They respond to monetary policy, fiscal stimulus, and time. Structural problems are permanent. They require fundamental rebuilding of capacity, systems, and relationships, and they do not resolve quickly. The data confirms this distinction. Manufacturing capacity utilization rates in key industrial sectors are declining despite stable demand. This should be impossible. If demand remains steady, capacity utilization should remain steady. But it is not happening. Why? Because the capacity itself is disappearing. Factories are closing not because orders have dried up, but because they cannot secure the inputs needed to maintain production. Suppliers are exiting markets not because of weak demand, but because they cannot source the materials required to manufacture their products. The entire chain is contracting. Inventory to sales ratios tell the same story. For decades, businesses optimized inventory management around the principle of efficiency. Keep inventory low, order just in time, minimize storage costs, maximize return on capital. This approach worked brilliantly in a stable supply environment, but that environment no longer exists. Now, companies that maintained lean inventories are discovering that replacement inventory is unavailable at any reasonable price or timeline. The shelves are not refilling. The procurement manager in Ohio represents thousands of his counterparts facing identical challenges. They are calling suppliers who cannot commit to delivery dates. They are receiving quotes with price escalation clauses that make financial planning impossible. They are watching competitors who secured supply agreements earlier gain decisive advantages. And they are beginning to ask a question that most executives have not yet confronted. What if this is not temporary? What if the supply infrastructure that enabled global manufacturing for the past 3 decades has fundamentally changed? What if the cliff is not something approaching in the future, but something already beneath their feet? The business press has not yet recognized the pattern. Financial analysts continue modeling supply chains as if the disruptions of 2020 through 2023 were anomalies that have now resolved. Central banks continue focusing on demand-side inflation management, assuming supply will normalize on its own. But on factory floors, in procurement offices, and in operations centers, the people who actually move physical goods through the economy are seeing something different. They are seeing the early stages of a supply cliff. And unlike 1980, when the problem was primarily energy and policy-driven, this cliff has been built into the structure of global production itself. It has been decades in the making, and it is just beginning to reveal its full scale. The question now is not whether the cliff exists, but how far the fall will go. In 1987, a consulting firm presented a revolutionary idea to the executives of a major automotive manufacturer. The idea was simple: eliminate warehouses, reduce inventory to near zero, order components only when needed, deliver them directly to the assembly line within hours of use. The executives were skeptical. What if suppliers failed to deliver on time? What if a single disruption halted the entire production line? What if the cost savings were offset by operational chaos? The consultants showed them the mathematics. Warehouse costs eliminated, capital freed from inventory storage, efficiency gains of 15 to 20%. The executives approved the pilot program. Within 3 years, the system was operational across all facilities. Within 10 years, it became the industry standard. Within 20 years, it was considered basic competence in manufacturing management. They called it just-in-time production, and it worked flawlessly for nearly 3 decades. But what those executives in 1987 could not have known, what the consultants did not model, what nobody in that boardroom could have predicted, was that they were building the first layer of the supply cliff. The optimization that made perfect sense in 1987 created a vulnerability that would become catastrophic in 2025. This is how the cliff was constructed, not through a single decision, not through malice or incompetence, but through thousands of rational choices that compounded over time into structural fragility. Phase 1 began in the 1990s, the efficiency paradigm. Every major corporation adopted the same philosophy. Inventory is waste. Redundancy is inefficiency. Multiple suppliers for the same component represent unnecessary cost. The logic was unassailable. If a company could source a component from one reliable supplier instead of 3, why maintain relationships with 3? If inventory could be reduced from 60 days to 6 days, why carry the extra 54 days? If warehouses could be eliminated, why pay for storage? One by one, businesses eliminated buffers. They reduced safety stock. They consolidated supplier bases. They optimized every kilogram of inventory out of their systems, and their profit margins expanded. Their return on capital improved. Their stock prices climbed. Wall Street rewarded them. Business schools taught their methods as case studies in operational excellence. But beneath the efficiency gains, something else was happening. The system was losing resilience. A supply chain with no redundancy cannot absorb shocks. A production system with no buffer inventory cannot withstand disruptions. A network dependent on single sources cannot survive supplier failures. Nobody noticed because nothing failed. The system worked perfectly until it didn't. Phase 2 accelerated the process. The globalization trap. Between 2000 and 2020, manufacturing capacity migrated across borders at unprecedented scale, not because of trade policy alone, but because the efficiency paradigm demanded it. Why manufacture components in Germany when China offered production at 1/3 the cost? Why maintain domestic suppliers when Southeast Asian facilities provided identical quality at 40% lower prices? Why preserve multiple geographic sources when a single optimized facility in Taiwan could serve global demand? The decisions made economic sense. Every individual choice increased profitability, but collectively, they created geographic concentration that defied basic risk management principles. By 2019, more than 60% of global semiconductor production capacity existed in Taiwan. More than 70% of rare earth element processing occurred in China. More than 80% of certain pharmaceutical ingredients came from facilities in India and China. Single facilities became responsible for supplying entire global industries. Single regions became irreplaceable nodes in worldwide production networks. And the companies dependent on these sources convinced themselves that geopolitical stability was permanent, that supply relationships were secure, that optimization had no hidden costs. Then came Phase 3, the perfect storm. In early 2020, a virus emerged in Wuhan, China. Within months, global supply chains experienced disruptions unlike anything in modern history. Factories closed, borders shut, logistics networks collapsed. For the first time in decades, businesses discovered what their efficiency-driven systems had sacrificed. There were no alternative suppliers to call. There were no backup inventories to draw upon. There were no redundant facilities to activate. The buffers were gone. The resilience had been optimized away, and the carefully constructed just-in-time systems failed simultaneously across every industry. Most executives assumed the pandemic disruptions were temporary. They believed supply chains would return to normal once the virus subsided. But something else was happening beneath the surface. Suppliers that shut down did not restart. Workers who left manufacturing did not return. Facilities that closed were not rebuilt, and geopolitical relationships that fractured did not heal. By 2022, a new pattern emerged. Deglobalization, not as policy or ideology, but as practical reality. Countries began restricting exports of critical materials. Corporations began questioning concentrated supply sources. Governments began demanding domestic production capacity. The globally optimized supply network that took 30 years to build began fragmenting, and businesses discovered that reversing 3 decades of optimization could not happen quickly. You cannot rebuild domestic manufacturing capacity in months. You cannot recreate supplier relationships overnight. You cannot train skilled workers instantly. You cannot construct new facilities without materials, and those materials come from the same constrained supply chains you are trying to escape. This is how the cliff was built, layer by layer, decision by decision, optimization by optimization. Each choice rational in isolation, but catastrophic in combination. And now in 2025, the business world is discovering what happens when structural vulnerabilities meet real-world stress. The cliff does not collapse all at once. It crumbles gradually, then suddenly, and the fall has already begun. In September 2024, a construction project manager in Phoenix received an email that made no sense. The email came from his steel supplier, a supplier he had worked with for 11 years, a supplier that had never missed a delivery. The email said the project's steel beams, ordered 4 months earlier, would not arrive as scheduled. The new delivery date was uncertain, possibly January, possibly March, possibly not at all. The project manager called immediately. He assumed there had been a mistake. The supplier's voice on the phone sounded tired, almost resigned. "It's not just you," the supplier said. "We can't get the raw material. Our mill in Indiana is running at 40% capacity. They can't source the alloy inputs they need. Their supplier in South Korea stopped taking orders. Something about power grid constraints and export restrictions." The project manager hung up. He looked at his construction timeline. A $23 million commercial building, 70% complete, now stopped. Not because of funding, not because of permits, not because of labor, but because steel beams were unavailable. He called 6 other suppliers that afternoon. 4 were not accepting new orders. 2 quoted prices triple the original estimate, with delivery timelines extending into late 2025. The project went on indefinite hold. 3 weeks later, the developer filed for restructuring. This story is repeating across every sector of the global economy. Not in headlines, not in breaking news alerts, but in quiet emails, phone calls, and boardroom meetings where executives are discovering that the products they need simply do not exist in available supply. The cascade has begun. In the semiconductor industry, the crisis moved beyond chips themselves. A medical device manufacturer in Boston needed specialized sensors for diagnostic equipment. The sensors required microcontrollers. The microcontrollers were back-ordered for 18 months, not because of chip shortages alone, but because the packaging materials for the chips were unavailable. The packaging materials required ceramic substrates. The ceramic substrates required rare earth elements. The rare earth elements were subject to export quotas from China. One missing component. 7 layers deep in the supply chain halted production of life-saving medical devices. The manufacturer could not find alternatives. The specifications were too precise. The certifications too specific. The regulatory approvals too lengthy. Production stopped. Healthcare systems that depended on those devices began rationing existing equipment. The cascade continued. In agriculture, a different pattern emerged. A farming cooperative in Iowa ordered fertilizer in March 2024 for spring planting. The fertilizer arrived. But when they ordered equipment parts for their tractors, nothing came. Hydraulic components were back-ordered indefinitely. The parts were manufactured in Germany. The German facility needed specialized steel alloys. The alloys required nickel from Russia and cobalt from the Congo. Geopolitical tensions had disrupted both sources. The farmers improvised. They repaired equipment with salvaged parts. They reduced planted acreage. They delayed maintenance. But improvisation has limits. By harvest season, equipment failures had increased 40%. Crop yields declined not because of weather or disease, but because the physical tools of farming were deteriorating faster than replacement parts could arrive. Food production was contracting because of industrial supply failures. The connection was invisible to consumers, but it was real. In the technology sector, the effects manifested differently. A software company in San Francisco planned to expand its data center operations. They ordered servers in February 2024. Delivery was scheduled for June. June passed, then September, then December. The servers never arrived. The manufacturer explained that power supply components were unavailable. The components required inductors. The inductors required magnetic materials. The magnetic materials came from a single facility in China that had reduced production due to environmental compliance requirements. No servers meant no expansion. No expansion meant no capacity for new customers. No new customers meant revenue targets missed. Stock price declined. Investment plans were canceled. A digital company paralyzed by physical constraints. The pattern was spreading. In the pharmaceutical industry, the cascade reached critical medications. A generic drug manufacturer in New Jersey produced blood pressure medication used by millions of patients. In October 2024, they sent letters to hospitals and pharmacies. Production would cease within 60 days, not because of regulatory issues, not because of business decisions, but because they could no longer source the active pharmaceutical ingredient. The API came from India. The Indian facility had shut down. The reason given was input material shortages. The input materials were specialized chemical precursors. The precursors were manufactured in China. China had implemented export controls on certain chemical compounds for national security reasons. The precursors were on that list. One policy decision in Beijing eliminated a medication supply for millions of patients in America. Alternative sources did not exist. Alternative medications were already facing similar constraints. Healthcare systems began preparing rationing protocols. Across every industry, the same realization was dawning. The disruptions were not temporary. They were not isolated. They were not resolving. In corporate boardrooms, executives were reviewing supply chain audits that revealed terrifying dependencies. Critical components with single sources, materials with no substitutes, suppliers with no backup options, and lead times extending so far into the future that financial planning became impossible. An automotive executive in Detroit reviewed a risk assessment in November 2024. His company depended on 17,000 individual components to build a single vehicle. The audit identified 247 components with critical supply vulnerabilities, components that, if unavailable, would halt all production. He asked his procurement team how long it would take to develop alternative sources. The answer was 3 to 7 years. Assuming the alternative sources could be developed at all, he looked at the company's production schedule, then at the audit results. Then he understood. His company was not managing supply chain risk. They were gambling against a cliff they could not see, and the ground was already crumbling. In financial markets, this reality had not yet registered. Equity analysts were modeling supply chain normalization by mid-2025. Commodity traders were betting on mean reversion in prices. Central banks were declaring victory over inflation. But in warehouses, factories, and distribution centers around the world, the people who actually moved physical goods knew something different. Inventory levels were not rebuilding. Order backlogs were not shrinking. Delivery timelines were not improving. The cascade was accelerating, and what began as isolated disruptions in specific sectors was merging into a systemic crisis that transcended industries, borders, and conventional economic categories. The supply cliff was no longer theoretical. It was operational, and the fall was gaining speed. In January 2025, the CEO of a mid-sized industrial equipment manufacturer faced a decision that would define his company's future. His CFO presented two options. Option 1, secure a 3-year supply contract for critical steel components at prices 47% above current rates. The contract would consume significant capital. It would reduce quarterly earnings. It would likely trigger negative reactions from investors and analysts who expected margin expansion. Option 2, continue with existing procurement practices, negotiate better prices, wait for supply conditions to normalize, preserve capital, maintain margins, meet quarterly targets. The CFO recommended option 2. The CEO chose option 1. Within 6 months, 3 of his direct competitors had suspended production due to material shortages. His company was operating at full capacity. Market share shifted dramatically. By December 2025, his stock price had doubled while competitors filed restructuring plans. The difference was not better technology, not superior products, not more efficient operations. The difference was recognizing reality before others did, and acting on that recognition despite conventional business logic arguing against it. This is the strategic imperative now facing every business leader. The supply cliff is not a problem to be solved. It is a new operating environment to be navigated. And the businesses that survive, that thrive, will be those that abandon the assumptions of the past 3 decades and embrace a fundamentally different approach to production, procurement, and strategic planning. The first requirement is brutal honesty about dependency. Most companies do not actually know their supply vulnerabilities. They know their direct suppliers. But they do not know their suppliers' suppliers. They do not know the geographic concentration of critical materials 7 layers deep in the supply chain. They do not know which single facility, Which single process, which single source represents an existential threat to their operations? This ignorance was acceptable when supply systems were stable. It is catastrophic now. The strategic imperative begins with mapping. Complete supply chain visibility, not just first-tier suppliers, but second, third, and fourth tiers. Identify every critical input, trace it to its source, understand the dependencies, recognize the vulnerabilities. An electronics manufacturer in Taiwan conducted this exercise in mid-2024. They discovered that 43% of their product line depended on components from a single facility in Malaysia. The facility sourced materials from 3 countries, 2 of which had export restrictions under consideration. If any link in that chain failed, nearly half their revenue would disappear. They immediately began developing alternative sources. It took 9 months. It cost $12 million. It reduced margins by 4%. But when the Malaysian facility experienced a power grid failure in March 2025 that shut down operations for 11 weeks, they were the only company in their sector that maintained production. Orders flooded in from customers whose primary suppliers could not deliver. The $12 million investment generated $83 million in new revenue. This is the new calculus. Resilience is not a cost. It is competitive advantage. The second requirement is inventory strategy revision. For 30 years, businesses optimized around lean inventory. That paradigm is dead. In an environment where replacement inventory is unavailable, buffer stock is not inefficiency. It is survival. A pharmaceutical distributor in Germany recognized this in early 2024. Against every principle of modern inventory management, they increased stock levels for critical medications by 300%. Their warehousing costs tripled. Their capital efficiency metrics deteriorated. Financial analysts downgraded their stock. But when API shortages hit in late 2024, they had supply while competitors rationed. Healthcare systems that depended on consistent medication availability shifted all contracts to them. Market position that took competitors 15 years to build transferred to them in 6 months because they had inventory when inventory mattered more than efficiency. The third requirement is supplier relationship transformation. The transactional approach to suppliers, constantly seeking lowest cost, switching sources for marginal savings, is now strategically dangerous. Suppliers are not commodities to be optimized. They are partnerships to be invested in. An automotive manufacturer in South Korea began restructuring supplier relationships in 2023. They reduced their supplier base by 40%. But for the suppliers they retained, they did something unusual. They offered long-term contracts at premium prices. They provided technical assistance. They helped finance capacity expansion. They treated suppliers as strategic assets rather than cost centers. When supply constraints intensified in 2024, their suppliers prioritized their orders. While competitors scrambled for allocation, they had guaranteed supply. The premium they paid for supplier relationships was a fraction of what competitors paid in production delays and lost sales. The fourth requirement is vertical integration reconsideration. For decades, the trend was outsourcing. Focus on core competencies. Let specialists handle everything else. That logic assumed specialists would always be available. They are not. Some companies are reversing 30 years of outsourcing decisions, bringing critical processes in-house, rebuilding capabilities they deliberately eliminated. An aerospace component manufacturer in France re-established its own foundry operations in 2024. They had outsourced metal casting in 2003 to reduce capital requirements. For 20 years, it was the right decision. In 2024, their casting supplier shut down. No alternatives existed within acceptable quality and certification standards. They faced a choice: rebuild casting capability or exit certain product lines. They rebuilt. It cost 28 million euros. It took 14 months. But it secured supply for products generating 200 million euros in annual revenue. The ROI was incalculable because the alternative was zero revenue. The fifth requirement is time horizon extension. Quarterly thinking is incompatible with supply cliff navigation. Decisions that make sense over 12 months may be catastrophic over 36 months. Decisions that damage near-term earnings may be essential for long-term survival. This creates tension with financial markets that reward short-term performance. But the companies that prioritize market perception over operational reality will not survive the cascade. An industrial chemicals producer in Texas faced this tension in early 2025. They could maintain current margins by continuing existing procurement practices, or they could secure long-term supply at significantly higher costs. Maintaining margins would please analysts for 2 or 3 quarters. Securing supply would ensure operational continuity for years. They chose supply. Stock price declined 9% in the following month. By year-end, it had increased 43% as competitors' production failures became apparent. The market eventually recognizes reality. But by the time recognition arrives, strategic position has already been determined. This is the ultimate message for business leaders. The supply cliff is not coming, it is here. The cascade is not theoretical, it is operational. And the window for strategic response is closing rapidly. Every month of delay increases vulnerability. Every quarter spent waiting for normalization compounds disadvantage. The businesses that recognize this moment for what it is, a fundamental reset in how production, procurement, and supply must be approached, will gain advantages that competitors cannot overcome. Those that continue operating on assumptions built during 3 decades of supply stability will face constraints they cannot solve. The question is not whether your business will be affected. The question is whether you will adapt before or after your competitors. Because in the cascade, position determines survival. And position is being determined right now. The cliff is real. The fall has begun. And what happens next depends entirely on whether business leaders choose to see reality or wait until reality forces itself upon them.